We're here to, oh, yeah, it is. We're here to talk about stablecoins and how institutions can utilize stablecoins with DeFi opportunities. I'm Tesa from Fight Club, which is Bankless DAO's investment DAO. I'm also the head of market research for the Flashbots team. So I'm going to introduce my panel, or actually they're going to introduce themselves, and we'll get right at it.
Hi, my name is James Burkett. I'm a co-founder and partner at a liquid fund called Florin Digital. We focus on early stage opportunities with tokens. Previously, I was a exec at a number of, crypto protocols, fintechs, and deep tech companies. And I think I'm on this panel because in a previous life, I worked with some of the biggest financial companies on earth.
My name is Raoul Schipper. I work at Chainlink Labs doing strategic accounts. In my previous job, I worked on a couple of CBDC projects at major consultancies and a couple of tokenization projects with major banks and TradFi institutions.
I'm Terence, head of growth at Dinero. Handle a lot of the institutional products that we're going to launch in the upcoming months, always DeFi.
Hey everyone, I'm Antoine, Loth. I'm head of BD at Euler, and we are a lending protocol launching very soon. That's going to be very modular, flexible, and efficient.
All right, thanks for that. Starting with you, James, what market opportunities do you see institutional players gravitating toward within crypto space?
I think the most obvious is payments, and I think I'll take a little contrarian approach. I think actually the biggest market for this is the United States. And so if you think about where money lives, half of the financial institutions, half of the money in the world is in the US. You also have some of the biggest credit card companies facilitating the most transactions. So I think that is an area to be completely disrupted. I think DeFi is a really easy inroad to that. If you look at the banking system, this is software that was built 30, 40 years ago, and we've massively overhauled it with this decentralized ledger. I think the first step there is smart regulation and allowing people to figure this out, people to put rules on paper so companies like Euler, companies like Chainlink, Dinero, et cetera, can actually operate in these markets. So I would say the largest institutional opportunity is most definitely payments, and where I would say it lives where the most money lives.
Raoul, what do you think?
I think I would break it down between buy side, sell side, and infrastructure, where the sell side sees, for example, MakerDAO, they see the Biddle Fund, these kinds of places. They see DAOs accruing a lot of money and a lot of value, and they want to sell to them. So they want to tokenize treasuries, for example, bring those on chain, and basically do what they do in TradFi, but then in DeFi. The buy side is much more interested in earning, for example, the yield that exists in DeFi. So if they feel like they can fairly safely capture yield, what they might be doing is building, frankly, something fairly similar to like Efina, for example, where they capture a particular yield that exists in DeFi and then try to sell that to somebody else, usually. And then there's a whole bunch of infrastructure companies, and often infrastructure is part of this, where it's all about, hey, this is actually a lot more efficient than what we're doing now, so how about we try to utilize the blockchain to settle particular transactions, for example. So stablecoin transactions is one of those things. And frankly, we work with a lot of those places often, like, for example, a Swift and a DTCC, which is much more about capturing basically the difference between what you're paying now for a transaction versus what you could be paying if you use blockchains. So there's really like 3 different places, frankly.
And Terence, what do you see at Dinero?
We kind of found that most institutions are limited to one of 2 options, either investing in products through the ETP side of things or funds. Both these products are like severely like underserving, right? On the ETP side of things, there's a lot of like yield or carry left on the table, and on the funds, they are super limited in terms of what they offer. In terms of like compliance, these guys are basically just running like validators in-house. So what we're kind of trying to do is address that. It's kind of solving like commingled liquidity issues. Offering solutions for guys that are allocating to either like Bitcoin or ETH and just leaving a lot on the table.
Antoine?
Yeah, I mean, I think globally, for institutions, and even if we forget institutions, it's like cross-border transactions and payments. I agree with James. But on our side at Euler, we see mainly, institutions using, stable coins to trade. So, to earn yield, use them as collateral to borrow more and create some strategies. And we mustn't forget that at the end of the day, also stable coins allow these institutional players to have a unit of account on which they can really materialize and translate profit in a number that is understood by their LPs. So it's really the lifeblood of DeFi as well. in that extent. But overall, in volumes, I think it will be cross-border transactions and payments, yeah.
So do you all agree that it's mainly a US-focused thing, or do you feel like there's other geographies involved?
I mean, not at all, because if you look at today, the places where stablecoins will be the most used it is definitely US and Europe and Asia, and jurisdictions where there is some sort of regulatory clarity around stablecoins, and where actors are encouraged to have a lot of transparency around the collateralization factors and onboarding processes, etc. But we see that in emerging economies, stablecoins are used to a much broader extent by the population, and this means that institutions there will have to follow. So I think it's a pretty global movement, but I hope that all over the world, the regulatory standards that we see in the US and in Europe will become a norm.
Yeah, for us, we're staying out of the US for now. Mostly like Europe and Middle East, North Africa, but yeah, getting there, hopefully.
Yeah, I mean, if you look at the global AUM, as you would call TVL in normal institutional language, about 75% is in the US and Switzerland. So if you look at just where are the dollars, that's probably still the place.
And then James, next question for you is there a stablecoin that institutions prefer? Is it just USDT or USDC, or what about these other smaller algo stablecoins?
I mean, from our perspective, I guess, if you're counting us as an institution, we're a small fund, so we have no real preference, but I think understanding the risk parameters of each. Is this a, fiat-backed stablecoin? Is this something that's, backed by levered dog shit? Or like, what do I actually own? I think people use the word stablecoin pretty broadly. But then people look at USDC for stability. Well, that depegged 7%, and you needed a stroke of God to bring it back. And when SVB failed, I think there's a lot of issues around what these things actually are. But I would say institutions, there's ones they don't prefer, or they would go against. But I can't say that anyone is like, oh, we're diehard Tether or diehard USDC.
Do you guys find the same? It's Tether versus USDC for major stablecoin dominance?
I do think this might change in the future, especially when you look at, for example, the recent MiCA laws in the European Union, where one thing that's actually quite relevant to funds and institutions is if you hold a USDC, it isn't $1. You have to actually know what it's worth. You have to mark it every day at the actual value, which brings a bunch of accounting overhead. Well, if you were a MiCA compliant stablecoin, you can just hold it on the books as though it is the fiat currency, for example. So that might make that a lot easier. And we might frankly see a lot more growth of MiCA compliant stablecoins just for that reason alone.
Yeah, I think it comes down to liquidity preference, and that ends up being USDC and USDT. It's the boring answer, but they're not letting us accept in-kind and algo stables, So.
Fair.
Yeah, similar.
How sophisticated are your institutional investors? I'll start with you, Terence.
They're not sophisticated. Yeah, I hope they're not watching this. But yeah, they're just relatively unexposed. They're new institutions. Our product is not so much something that I don't think anyone here would really be using so much. It's not DeFi focused. We're DeFi natives, and we're good at building liquidity infrastructure and yield that hopefully scales. But yeah, these are guys that are sitting on ridiculous 9-figure stacks of Ethereum or Bitcoin. And leaving a lot of money on the table. So yeah, if you're an institution, they've really only been able to pump money into these funds that are, like I said, running in-house validators, and that's 2-3 points, 2 after fees. So yeah, what we're doing is almost twice that, just because of, we took what we already had, addressed commingled liquidity, and it looks to be working, but these aren't guys that have ever dabbled in DeFi at all. These are guys just directionally long and not trying to do much else.
Antoine, what do you see?
So yeah, the vast majority of institutions are really not familiar with DeFi. There's a couple of yield funds and hedge funds which are extremely sophisticated. And now we start seeing more and more of these hedge funds that were trading in centralized exchanges now starting to dip their toes into DeFi. Also, there's a few, I would say, kind of hybrid players that do a bit of VC, so can be investing in a stablecoin and then and then LPing, and all of the various use cases around the stablecoin. What I would say is that there starts to be, and we see it at Euler, a lot of initiatives around experts in risk or in structuring products or even regulated entities that want to build kind of like structured products and composite products where a stablecoin is a unit of account. So basically what it means is that you deposit some stables into a pool, and a pool or whatever instrument or vault, this runs a strategy that brings yield, and then this instrument can even, you can even add permissioning around it and compliance, and it can then be distributed to, family offices. We start seeing that and hear about this, which a couple of years ago was unthinkable. DAOs and treasuries, that's a bit more straightforward, but the ones that don't want to actively trade. And another use case that we'd love to see happen closely in the future, I know some of you here are looking at it, is, why doesn't the yield that people earn on, their bank account or their fintech app or whatnot, why doesn't it come from DeFi, right? So there's a lot of composability now and compliance solutions that can make that happen.
I think you touched on a really interesting point on like the compliance wrapper. Like we get this question all the time. It's like, how do I know I'm not trading with like El Chapo or North Korea? And like as soon as someone has that compliant wrapper that institutions are comfortable with and they're going to use, like that's the horse you want to be behind. I mean, I think that's. I couldn't tell you how many times we get that question, and it's a really difficult one to answer with real accuracy. And so I think there's a number of teams working on stuff like that. But as soon as that's something there, I think you're going to really see the inflow of capital because they can understand that they're not, facilitating terrorism, or they're okay with it. They're not going to lose their job because of what they've, decided to do on chain in this weird DeFi world.
So you're saying people kind of prefer the Athena style, where it's a CeFi trade coming on chain into DeFi?
I don't know if I would say that they prefer it as a. I mean, I think it's a. I don't think people are thinking of it as a stablecoin. I think they're thinking of it as a structured product, which I think is completely fair. But I think the biggest issue, again, I would say, is making sure that you know who your counterparties are, and if you're in a, 3 pool on Curve, do you actually know that this is a pool where some militant group is earning some yield as well?
Raoul, any insights?
Yeah, I think you did see a massive increase in the sophistication, at least DeFi sophistication, in 2021 and 2022. When we were talking to like central banks, they were completely uninterested in any of this stuff. And then suddenly money was like sprouting out of the ground across all of DeFi. Everybody was earning 70,000 yield, and oh my God, what was it, like Olympus DAO went to like 7,000% or whatever. That's when they got really interested, because even though they were skeptical of the amounts that were being earned, that's money, and I'm trying to sell to people. I'm trying to earn from people. Like, yield is basically the lifeblood of this kind of industry, and they increased a lot of sophistication. So that's when you, for example, saw central banks forking Uniswap and forking Curve and trying out, for example, Aave, and talking to us about how can I get into this lending game. And they wouldn't do it on public chains for the reasons that you mentioned, but they would spin up a Hyperledger instance and have like 4 central banks collaborate on Uniswap, which makes some sense somewhere, but maybe not at that time. And what you're seeing now is they're getting more and more comfortable with these public chains through, like, for example, this KYC AML wrapper, stuff like Chainalysis, frankly, as well. And they are increasingly getting comfortable with it. And you see this like curve from between, let's say, Optiver and flow traders who are making markets on, frankly, dog shit tokens sometimes in DeFi, all the way to the most boomer banks that might even be looking at buying Bitcoin at this point in an ETF form. Yeah.
So you're saying institutions are not airdrop point farming quite yet?
Well, no, probably not, no.
How do you think, how are they managing their risk, especially their stablecoin risk?
That's a very good question. I think this is their business. Like, as a bank, the fundamental thing you do is, I'm earning 3% yield by extending you a loan. Your risk of default is like 2.5%, and it costs me 0.2% to actually do the operationals. Okay, I can clear 0.3%. Maybe that's worth it, maybe that's not worth it. This type of risk trade-off is what they do. So they look very deeply at counterparty risk in particular, at least like the big banks and the central banks. And in that case, there's only a couple real names you're going to work with. So like that would be, for example, the Circle, right? Because the treasuries are with, like, what is it, BlackRock. And similar to something like a BIDL fund or whatever, like you need to know exactly who's holding your money and how safe that party is. If you look at, further down the risk curve, the prop funds and stuff, that's probably going to be a little bit different. But yeah, the big banks that I work with at the time, if it's not BlackRock, we're not really interested.
Are you seeing something similar, Terence? Are they looking down toward, like, say, Aave or even a Chainlink, or mainly just, regulated stablecoin issuers?
Yeah. In terms of like the stablecoin hedging thing, I think that they're already hedged, right? Like they're like stablecoins are on-demand liabilities, and like on the other side of the table, like they're just sitting on bills or whatever it might be. For us, like what we see is like they don't even really sit in stablecoins. Maybe it's just like the investors we're working with, but these family offices they'd rather like send us USDC to get into a fund than they would go through the bank, and we can do it. Like we can take money into our fund through like UBS Wealth Management, right? And you'd think these guys have preference for that, and some definitely do. But yeah, at the same time, a lot of them will opt for just like, let's just send them Tether, let's just send them dollars. Maybe it's just because it's the easiest to understand. Like you're saying, go check the balance sheet and make sure the money's there. But yeah, it's pretty boring, to be honest.
Antoine?
Yeah, I mean, it's quite similar. I guess 3 factors are, transparency, around collateralization, compliance is one thing, and then maybe liquidity as well. I mean, usually, institutions prefer stablecoins with tons of liquidity. So yeah.
James, what about you? You sitting on the fund side.
I mean, I think Terence touched on a really funny point. Like, anytime we can take subs in stablecoins, we do it because, again, we're a regulated entity in the Caymans. Like, people can find me if they need to find me. Like, we're not breaking any rules, regulations, and we're trying to be above board with all this stuff. But for us to get a wire from a U.S. bank takes 7 days. I mean, people understand in this room that moving stablecoins does not take 7 days, and so just from a practical standpoint, it just makes sense. To Raoul's point, the fact that it's not exactly marked at $1 is frustrating. It's really annoying going back to an LP and saying, hey, you sent us $1 million USDC, but it's only worth 999,000, et cetera, et cetera. But aside from that, I mean, we vastly prefer stablecoins. I mean, if our vendors take stablecoins, we'll send them stablecoins. I mean, it's a better horse. It's a better mousetrap.
Is there any opportunities for you guys to collaborate, or for institutionals to collaborate with stablecoin issuers and, say, regulatory bodies? Is there anything happening in that sort of front?
We're kind of doing something here. So what we're doing at Dinero is basically we started with the LST, just like on the premise of ownership of block space, right? And the idea that it's like a very good form of collateral. So we launched the LST, and now we've gotten into this like institutional mess with the LST. And it's boring, like you mentioned, like these permission wrappers these legal wrappers are just like permission tokens, right? So they're only mintable by the fund. But once you get there, you're in a really cool spot where you can start minting like the stable coins against this like permission CDP, which is going to be the next phase of things that we do. So yeah, you end up with this very cool like closed loop system for borrowing within the fund, and that's how we're approaching it. But.
Yeah, I mean, on our side, the main collaborations that the vast majority of stablecoin issuers will want to have their assets used as collateral to be lent out on Euler, which is going to be super interesting. It adds liquidity, can enable them for the yield-bearing ones to have even more minting, for example, and so on and so forth. And I mean, you said on the regulatory side, we've added the possibility to add permissioning and wrappers around the markets for people that want to have solutions that fit any regulatory environment they're involved with. So modularity, I think, for us is what brings solutions to people that want to use stablecoins as collateral, as a lendable asset, and for those that want to create markets.
Raoul or James, anything to add?
No, I think I'd echo with what everyone kind of said here. I think the biggest thing, especially for the U.S. market, is just put rules down. I mean, there's no idea. People have no idea what they're trying to do. I mean, I think crypto in general, like the people are efficient at finding new ways to do things. We just actually need guardrails or goalposts to try to swing between. And I think once we have that, there's a lot of really interesting builders that are doing a lot of really interesting things. But the first step is finding the parameters that they need to operate within.
So besides Mika, is there any sort of upcoming regulatory changes that you guys are saying, okay, this is going to be a game changer for stablecoins?
I think all the regulation that's going to come out, people are going to throw their hands up in the air and say, what the hell is this? But then they'll go back to the drawing board and realize that we can comply with this, we can do these things in a thoughtful way, and it's not really going to limit what you can actually do with DeFi. I think that's one of the really beautiful things about it, is that you have the ability to accommodate, you have the ability to evolve with the things that you're working with day in and day out, where that's not an advantage that TradFi has. Like they can't pivot quickly, they can't move and ship quickly. So I think, like I said, the regulation's going to suck, and then everyone's going to be mad about it, and then we'll go on our merry way, and it'll be completely fine.
Yeah, I mean, in normal banking, you have, so for example, you have a very large bank in the Netherlands. They have about 50,000 employees. About half of those are involved in just keeping the license. So you're going to have a lot of really stinky licenses coming out over the next couple of years. And even Mika, people were complaining. There's some good in there, there's some bad in there. But if you look at the more pragmatic regulatory regimes who are more willing to be, pragmatic about it, you're probably looking at like the UK, Hong Kong, Singapore, maybe Dubai as well. And I'm not saying they did it well or they did it poorly, but they're more likely to keep evolving this piece of legislation over the next couple of years and get to a place that's actually nice and useful. And I think Mika is actually quite important because it's such an enormous market. At least it gives clarity. Like even if it's not the right hoops you want to jump through, it shows you what you need to do, and it's clear. And we see actual like DeFi protocols. We see multiple different parties try to jump through these hoops because at least now they know what they're supposed to do. So at least that gives the clarity.
Yeah, we're really reliant on like asset managers that are willing to push the bounds, basically, similar to like protocols that, like James is saying, like are willing to like move fast. Asset managers that are willing to move fast are just as important, because until there is some clarity, right? Like you have to kind of operate within these like pre-existing constraints. So you can do your best, right? You can work on identifying counterparties and commingling and things like that, but until there's some like systemic clarity, we're really reliant on these asset managers that are willing to come in and say, okay, if we can operate on a similar framework and within these bounds, let's work on offering these products. And I think that's like more important than anything else, because that's what really spurs like this regulatory change, right?
I think very, very quickly also touching upon that point, what a lot of people don't realize is that very often when you issue a stablecoin, the entire tech stack needs to be approved by the regulator. So, for example, if you want to go to a new L2, you have to go back to your regulator and show them what you're actually issuing on, how it works, all this kind of stuff, all these bridges. These regulators need to actually get comfortable with what they're dealing with because they've never seen any of this stuff. Like in my previous job, I had to explain to a central bank what the concept of MetaMask is. Like, what is the bank? Who is holding this asset for you? It's me. Like it took multiple hours of workshops for them to even get ahead of that. And as they get more comfortable with this, as they've seen this L2 a couple times, as they've seen this bridge a couple times and understand the concepts, things will move a lot faster, I think.
Yeah, it's really interesting, right? Because like 95%, I would say, of like our job today is like education, like dealing with these asset managers and all these institutions, especially these family offices that like are looking at things, say, okay, I want crypto exposure, and then they hear DeFi and they're like, okay, we can go one step further. We end up like doing so much explaining. It's like they don't understand in terms of yield, everything's in terms of carry. They don't understand a two-token model. It's a junior and senior tranche. It's all education, which is kind of weird, right? Because you'd think that these guys would be in a little bit of a better place and should probably be educating us, but it's actually backwards. It's really like going to 0 to 1 in terms of what should we actually be regulating, rather than should we or should we not be allowing this.
Yeah, nothing to add here except on our particular case, modular structure will enable people to build synthetic assets on top of the lending market. So I suspect that some of these will be stable coins. And then it's, how do they do that with confidence depending on the jurisdiction they're operating in, right? So, yeah, the faster we have clear and, pun not intended, stable regulation, the better off we'll be.
I guess one more question that I'm kind of curious about is, institutions are already investing in, say, things that they know about treasuries being on chain. Are there other real-world assets that you're seeing them use stablecoins to invest in, like tokenized gold, tokenized real estate, which we talked about earlier? Is that something that's of interest?
Yeah, I mean, today there's like tons of solutions for treasuries. There's even maybe in some cases more service providers than treasuries themselves. And I think if, what's the most important thing is obviously for the yield to be attractive, but for, the risk-adjusted return and profile of the asset to be super clear. I think definitely treasuries prefer to just deploy in stables into solutions rather than to have to off-ramp to some sort of desk that, they don't really know what's going on, or, even their community is not really aware of, even though some of these, service providers are like super experienced companies. So I think, simplicity to access, transparency, and probably liquidity. So with that in mind, yes, there's a lot of cool stuff happening in RWAs in the real estate space and all of these other assets, but I still think that we have a long way to go. I mean, it's still going to be T-bills and more liquid stuff that will prevail.
Everybody else agree with that statement?
Pretty much. I think one note there as well is when he says it's going to take a while, it is going to take a while, because why are you tokenizing something if nobody's willing to buy the token? So if there's no demand for a lot of real estate on chain, why are we going through the effort? And there's a lot of talk about real estate on chain, but the reality is if you actually tokenize something, it doesn't instantly become liquid. And there aren't like 1 million people suddenly clamoring to buy this particular piece of a house in like Austin, Texas or something. So if, for example, Dow treasuries become interested in something, you will find people jumping through the hoops, like with US like treasuries, for example. If you want something bad enough, somebody's going to go and tokenize it. But there needs to be somebody willing to buy the asset on the other side, because why else are you doing it? If you're thinking more practically, it's not a stablecoin, but for example, like the type of work that we're doing, like a Swift or a DTCC, those are real-world assets. Like that's actual cash, and that's like actual security clearing on DTCC that is flowing over chains. It's not always a public chain, but that is bringing on chain and going cross-border with actual cash, not even a stablecoin. So is that RWAs on chain? Probably. There is a ledger somewhere.
I think that hybrid approach is kind of interesting, and we've seen a few protocols doing something like this, where if you look at, say, the structuring of like a CLO, it's a total mess. You go pay Sullivan and Cromwell, $2,000 an hour to figure out how the flow of funds actually go through this product. It can just be done with a DeFi vault. It can be done very, very simply. It can be encoded. It can be put on chain, and we're done. We don't have to keep paying lawyers. We have a product that works, that functions, and it can be forked very easily. So I think those are kind of the, I would say, the RWA like use cases. If you can build look, it takes 4 or 5 days for US dollars to clear, euros to clear. And so if you can build a product that actually speeds that up with a stablecoin, you have a better mousetrap, right? Like it's actually using these to make markets bigger and improve them at the same time.
I'm going to open it up to questions from the floor. Does anybody have any questions for our panel? Raise your hand. Oh, just raising your hand, just to say hi. Okay, that's cool. All right, no questions. Panel, do you guys want to give your final thoughts and statements on stablecoins and institutions?
Sure. I think one of the biggest misnomers that people have about this industry with the institutions coming. So I think if you talk to anybody, they're going to say, okay, well, we want JP Morgan, Citigroup, we want BBVA to be on chain. Those are the institutions they're talking about, BNY Mellon. And I think people overlook the fact that Apple has $250 billion in cash on its balance sheet. That's a pretty easy convert versus a JP Morgan. JP Morgan has no incentive to come on chain. That's literally eating their own business away. And so I think if you look elsewhere for the institutions, there are massive companies that would love DeFi-like yield if they can do it in a compliant way, and they're going to be a hell of a lot easier than getting through a U.S. regulatory regime or a Singapore regulatory regime. And I think that's an opportunity that's really, really underexplored.
Yeah, I agree with that. I think one other thing is that we see institutions playing around with DeFi. We see Société Générale putting a post up on like the MakerDAO forum to tokenize something for them. We see Circle basically doing a pitch to MakerDAO. We see central banks like forking Uniswap and using that in a lot of different places. So they are experimenting, and they're getting more and more comfortable with this space. Like the institutions aren't coming, they are here. They might not be here as much as you really want to, but most of these institutions are so ginormous with so many different desks and so many different things that they do. Like no bank is just going to shift $1 trillion into DeFi or whatever, but they are going to start trying it out and they're going to start offering it to users. And if users demand this kind of thing, if users use this kind of thing, you're going to see it grow over time. So in a couple of years, you're probably going to see a whole bunch of DeFi pools that are just for these institutions where they can play. And meanwhile, we can earn our 700% yield on our dog shit coins in other places.
Yeah, I think as much as like everyone in this room or this like general bubble might frequently think like it's so over, right? For most of these guys, like has not even started. 95% of everything is like still education, and everything is only like going to happen as much as like people are willing to build it. Like all this talk about liquidity and whatever RWAs, the liquidity is only as deep as like those are willing to provide, right? And most of these like TradFi institutions are very comfortable doing what they're doing now, like real estate and all these other things they do are very functional, like off-chain. And there's still like a lot of points of friction before they're actually very functional on-chain. So yeah, until we get there, like stablecoins are the best business in DeFi. And that's for reasons because we're all trapped in this bubble. So yeah, it's very early. It's not over.
Yeah, I agree with what's been said. I mean, what would be really interesting is to see these institutions, okay, they're not going to come and deploy trillions like straight away, but start co-building products with us to make money and to go and tap into, new markets. So what I just discussed before about them creating yield products, structuring new things, this is already possible. The building blocks are there. Everyone wants yield, so I think that's what we're all working towards, and it will happen sooner than we think.
All right. Well, thank you so much, panelists. Thank you guys in attendance.